The million-dollar question. Amabru, picking your path to wealth. Have you ever wondered if you should invest in that flashy tech company everyone talks about, or that boring old bank that's been around forever? This is the core of one of the biggest debates in the entire world of investing. It's a showdown between two heavyweights: value investing, growth investing. One strategy is like a slow and steady marathon runner, building wealth with patience and discipline. The other is a sprinter, aiming for explosive gains in a short amount of time. Both paths have the potential to make you a lot of money, but they operate on completely different philosophies and come with their own unique set of risks and rewards. Understanding the difference isn't just some technical jargon for Wall Street experts. It's a fundamental choice that will shape your entire investment journey. The decision you make will determine the kinds of companies you own, the level of risk you take on, and even how you react when the market inevitably goes crazy. This isn't about finding a single right answer that works for everyone, because that doesn't exist. Instead, it's about discovering the right answer for you. By the end of this, you'll have a crystal clear picture of both strategies and be able to confidently decide which path, or which combination of paths, aligns with your personal financial goals. The year 2025 presents a unique economic landscape, and investors are watching closely. After periods of intense market volatility and shifting interest rates, the question of whether value or growth will come out on top has never been more relevant. Will the market favor the solid, undervalued companies that offer a margin of safety? Or will it reward the innovators and disruptors who promise exponential expansion? This essay will break it all down for you in simple, easy-to-understand terms. We'll skip the complicated financial models and confusing acronyms. We're going to talk straight, use real-world examples, and give you a practical roadmap to start building your portfolio today. The goal here is simple: to demystify this classic investment dilemma so you can make smarter, more informed decisions with your hard-earned money. Whether you have $100 or $100,000 to invest, the principles are exactly the same. We will explore what makes a value stock, what gives a growth stock its incredible potential, and how they perform under different market conditions. We'll also give you a step-by-step guide to get started, so you can stop watching from the sidelines and start putting your money to work. Let's get into it. Alright. The Value Hunter's Playbook. May komora dax, baubaning pinsto. Buying dollars for 50 cents. Value investing is, at its core, a form of bargain hunting. Imagine walking into a store and finding a brand new high-quality laptop on the clearance rack for $200, even though you know it's easily worth $400. A value investor applies this exact same logic to the stock market. They search for fundamentally strong, profitable companies that the market has overlooked or unfairly punished. These investors believe the stock's current price does not reflect its true, underlying worth. They aren't interested in what's popular, they're interested in what's cheap relative to intrinsic value. To find these hidden gems, value investors use simple but powerful metrics. One of the most common is the price-to-earnings, P/E ratio. This number tells you how much you are paying for every dollar of the company's profit. A low P/E ratio, especially compared to competitors or the broader market, can be a signal that a stock is on sale. Another key metric is the price-to-book, P/B ratio, which compares the company's stock price to its net asset value. If the P/B ratio is less than 1, it theoretically means you could buy the whole company, sell off all its assets, and still make a profit. The legendary investor Benjamin Graham, who was Warren Buffett's mentor, famously called this concept the margin of safety. This is the crucial buffer between the price you pay for a stock and its estimated real value. Even if the company's future isn't as bright as you predicted, your initial low purchase price helps protect you from catastrophic losses. This is why value investors are often incredibly patient, willing to hold on to a stock for years while they wait for the rest of the market to recognize its true value. These investors often favor established companies with predictable earnings, strong balance sheets, and a history of paying dividends. A dividend is a small cash payment the company gives to its shareholders, providing a steady stream of income even if the stock price isn't moving much. This approach is less about chasing quick, dramatic gains, and more about a methodical, disciplined process of accumulating wealth over the long term. It requires a mindset that can ignore the daily noise of the market and focus solely on the underlying fundamentals of the business, Chasing the rocket ship, another bias in the Bapikunber. The thrill of growth investing. If value investing is about finding a bargain on a reliable used car, growth investing is about getting in on the ground floor of a company building a flying car. Growth investors are not looking for what's cheap today. They're looking for what will be huge tomorrow. Their focus is on companies that are expanding their sales, revenue, and market share at a much faster pace than the average company. These are often innovators, disruptors, or pioneers in emerging industries like artificial intelligence, biotechnology, renewable energy. They are the companies poised to change the world and deliver explosive returns to shareholders. Unlike value investors poring over balance sheets for hidden assets, growth investors are looking for signs of rapid expansion. They want to see soaring revenue growth quarter after quarter. They get excited about companies that are capturing new customers. Many growth companies don't pay dividends. They invest in research and development, marketing, or acquisitions to accelerate their dominance. The bet is on future potential, not present-day stability. Because the market has high hopes, growth stocks often trade at very high valuations. You'll frequently see sky-high price-to-earnings, P/E, ratios. A P/E of 50, 100, or even higher is not uncommon. Investors pay a premium for current earnings because they expect those earnings to multiply. That optimism is both the greatest strength and the biggest risk. If a company delivers, the stock can soar, making early investors wealthy. If growth fails to materialize, the fall can be dramatic. If a growth company reports slowing sales or misses earnings targets, investor confidence can evaporate, and the stock can plummet. Growth investing is inherently more volatile and risky than value. It attracts investors with a higher tolerance for risk and a longer time horizon, willing to endure ups and downs in pursuit of outsized rewards. Head-to-head, a no-nonsense comparison of value and growth. When we put value and growth side by side, their differences become incredibly clear, especially when you look at returns, risk, and your time commitment. Historically, leadership has swung back and forth between the two styles. There have been decade-long periods where growth stocks, led by technology and innovation, delivered breathtaking returns that left value stocks in the dust. Then, the pendulum swings, and the market favors the stable, profitable, undervalued companies which then outperform for years. Neither style is permanently superior. Their success often depends on the broader economic environment, interest rates, overall market sentiment. The risk profiles are almost mirror opposites. Growth stocks carry higher risk because their lofty prices are built on future expectations. If a company fails to meet those ambitious growth targets, the stock can get crushed. A value stock, on the other hand, is perceived as having lower downside risk because its price is already depressed. However, value investing has its own pitfall, the value trap. This happens when you buy a stock because it looks cheap, but it's cheap for a good reason. The company is in a permanent decline, and its price never recovers. Your personal time horizon is another huge factor. Value investing is often a long-term game of patience. It can take years for an undervalued company's stock to be rediscovered by the market and appreciate to its fair value. You have to be willing to hold on through periods where the stock does absolutely nothing. Growth investing can also be a long-term strategy, but the path is often more volatile. Growth investors must constantly monitor their companies to ensure the growth story remains intact. If the competitive landscape changes or innovation slows, they may need to act more quickly to sell their position. Finally, think about volatility and your own stomach for it. Growth stocks are notorious for their wild price swings. It's not unusual for a popular growth stock to jump 10% on good news, or drop 20% on a disappointing earnings report. If watching your portfolio drop significantly in a single day would cause you to panic and sell, growth investing might be too stressful for you. Value stocks tend to be less volatile, though they are certainly not immune to market crashes. Let's make this super concrete with two simple, hypothetical examples. First, let's look at a classic value stock. Steady Auto Parts Inc., 50 years in business, manufactures essential car components, trading at $20 per share, earned $2 per share last year. Price to earnings ratio of 10. $20 divided by $2. Industry average PE, 15. Low debt, pays a reliable 3% dividend. A value investor thinks the market is undervaluing its stability. They buy, expecting the stock to trade closer to PE 15. If that happens, price would rise to $30 per share. $2 times 15. That's a 50% gain. Meanwhile, they collect the 3% dividend. Risk. The auto parts industry could slump, but the low purchase price limits downside. Solid assets and steady cash flow provide a floor under the stock price. Now, a growth stock. Future Tech Corp. Revolutionary software, growing fast. Pays no dividend, reinvesting every dollar, hiring engineers and expanding into new markets. A growth investor buys for potential, not current earnings. They expect revenue to grow 30% per year. In 3 years, EPS could double to $4. If PE stays at 50, price could reach $200 per share. $4 times 50. That's a 100% gain. The risk is immense. If a competitor releases a better product and growth slows, investors might lose faith. PE could collapse from 50 down to 20. Price could fall to $40, a 60% loss. Choosing between value and growth investing isn't just about crunching numbers, it's deeply connected to your personality, your financial situation, and your ability to sleep at night. Your personal risk tolerance is the most important factor. Would a 30% paper loss devastate you? If so, value investing might fit. Margin of safety, steady dividends. If you can stomach volatility and prefer big gains over fearing losses, you might be a growth investor. Growth portfolios swing dramatically, up and down. You need discipline to hold through downturns and restraint during euphoric highs. Excited by the next technological revolution? Can you handle the roller coaster? If yes, growth can be rewarding. Age and time horizon matter. A younger investor in their 20s or 30s has decades to recover. That long horizon makes growth risk easier to bear. Closer to retirement, priorities shift from wealth accumulation to wealth preservation. A 60-year-old focuses on protecting savings and generating reliable income. Finally, consider your time and interest. Value investing needs deep dive research, reading annual reports, analyzing financial statements. Growth investing needs staying on top of industry trends, technological innovation, and competitive threats. Jumping into the world of investing can feel intimidating, but the first steps are actually quite simple. You don't need to be an expert to get started. The best thing a beginner can do is to start with broad, diversified funds. Instead of trying to pick individual stocks, you can buy an index fund or an ETF that tracks a whole segment of the market. For example, you can buy a large cap value ETF, which holds hundreds of value stocks, or a large cap growth ETF, which holds hundreds of growth stocks. This instantly diversifies your investment and reduces the risk of picking a single losing company. The next step is to get comfortable with a few basic financial terms. You don't need a degree in finance, but you should understand what P/E ratio, earnings per share, and dividend yield mean. These are the vital signs of a company's health. You can find this information for free on websites like Yahoo Finance or on your brokerage platform. Learning to read these simple numbers will empower you to look at a company and get a quick sense of whether it's a potential value play or a high-flying growth opportunity. Knowledge is your best tool for building confidence. Once you're comfortable with the basics, you can start to dip your toes into picking individual stocks if you wish. Start small. Allocate a small portion of your portfolio, maybe 5% or 10%, to companies you want to research and own directly. Finally, and most importantly, create a simple plan and stick to it. Decide what percentage of your portfolio you want to allocate to value and what percentage to growth. Maybe you start with a 50-50 split. Then, set a schedule to review your portfolio, perhaps once a year or twice a year. This is called rebalancing. If your growth stocks have done really well and now make up 70% of your portfolio, you would sell some of them and buy more value stocks to get back to your 50-50 target. This disciplined process forces you to sell high and buy low, and prevents your emotions from derailing your long-term strategy. One of the biggest mistakes new investors make is chasing performance. You hear about a stock that has doubled in the last 6 months, you get a major case of FOMO, fear of missing out, so you jump in and buy it near its peak right before it cools off or declines. Classic recipe: buy high, sell low. A disciplined investor, value or growth, decides on fundamentals and valuation, not recent hype or momentum. Avoid chasing hot stocks everyone talks about. By the time you hear about them, the biggest gains are likely gone. Another trap for value investors: buying a value trap. It looks incredibly cheap for a very good reason. The business is fundamentally broken. Low PE could mean profits are about to disappear, technology is obsolete, or the company is losing market share. Ignoring the small stuff can sabotage returns, fees, taxes. Trading incurs fees every buy and sell. Selling within a year triggers higher short-term capital gains taxes. Active trading racks up costs that eat profits. A long-term mindset helps. Reduces trading frequency, lowers costs, improves tax efficiency. Mind the hidden drag of fees and taxes on your portfolio. Biggest mistake, letting emotions drive decisions. The market is a roller coaster of fear and greed. When the market crashes, we want to sell everything. When it soars, we want to pour money in, afraid to miss out. Giving in to emotions is the fastest way to lose money. Key to success, have a plan before chaos, remain disciplined during the storm. So, which will win in 2025? Value or growth? The honest answer is that nobody knows for sure. Anyone who tells you they do is trying to sell you something. We can still look at the current economic climate for clues. If interest rates remain relatively high, future profits of growth companies become less valuable today. That creates a headwind for growth stocks. In that environment, the market may favor value stocks, stable, present-day earnings, attractive dividend yields. Conversely, if inflation cools and the central bank signals rate cuts, that could reignite a rally in growth and technology stocks. Trying to perfectly time these cycles is a loser's game. The smarter approach is not to bet everything on one side. Build a resilient portfolio that can perform in any environment. For most investors, a blended approach is the smartest path. Own both value and growth to diversify. This balance smooths returns and helps you stay invested long-term. The debate is less about picking a winner and more about building your own all-star team. The best choice depends on your personal goals, your tolerance for risk, and your stage in life. Don't let headlines or market gurus pressure you. The most successful investment plan is the one you can stick with through good times and bad.